We just hit a new high in the stock market. The stock market's the highest it's ever been. And I expected that the market would be down 20-25%. I was willing to do that to get rid of a crazy country.
Hello and welcome to the week ahead on Nomura Podcasts. I'm Dominic Bunning, head of G10 FX Strategy based in London, and today is Friday the 8th of May. Well, as we just heard from the US President in recent White House comments, equity markets continue to move higher and risk sentiment across financial markets remains buoyant, with some signs of progress between the US and Iran around a potential memorandum of understanding around reopening the Strait of Hormuz. That said, as we record this, there's no concrete progress and a number of skirmishes continue in the Gulf despite the ongoing ceasefire. Oil prices have come off their highs, but with limited shipping movement into and out of the region, the implications of what's already transpired remain firmly to the downside for global economic activity and to the upside for inflation. Away from Iran, geopolitical attention will shift to the summit between US President Trump and China President Xi, held on the 14th to 15th of May. We're going to be discussing that with Harrington Zhang from our China economics team, while we'll also discuss local elections in the UK and India. We've also got Jeremy Schwartz on from our US economics team to talk us through the latest labour market data and look ahead to next week's inflation report. And all of this is happening in the context of recent FX intervention by the MOF in Japan, which has tried to limit the recent slide in the Japanese yen, albeit with only limited success. So there's a lot to talk through. With no further ado, let's get stuck in. Well, we're going to start this week in the US. It's Payrolls Friday. We've got Jeremy Schwartz with us from the US economics team. Jeremy, thanks for coming on. You seem to have, I think, just about digested the data in the last hour or so since it's come out. What did you make of the latest labour market report?
Yeah, so this was sort of a mixed bag report. We probably don't think it's going to change too many minds on the FOMC one way or the other. So, you did have a very solid NFP print. A lot of people were expecting mean reversion after strength in March. And you got some of that, but I think less than most people had penciled in. So, again, some signs there confirming what we've seen in claims data, what we've seen in ADP, which suggests that, there's a little bit of a firming up in the underlying trend of employment growth. At the same time, though, there were some dovish signals in the household survey. The unemployment rate actually ticked up slightly in unrounded terms, and you had a downside surprise in average hourly earnings. So again, I think that will kind of offer some confirmation to people on the FOMC who've been saying, there's no inflationary pressure from the labor market. We do continue to think that wage growth is likely to remain sticky. We think the weakness in April was largely just a technical one-off, and we do think the unemployment rate is likely to continue to drift lower through the end of the year. But for now, we're not seeing too many signs that the labor market is overheating or really running away from the Fed. So, net-net, we think this keeps officials focused on inflation risks. There's no real red flags here, no signs of an imminent deterioration. But at the same time, it probably takes some wind out of the sails from anyone who said that things are accelerating and maybe even pricing in near-term hikes.
Okay, great. In terms of the other part of the mandate, next week's going to be CPI data. Are we expecting there to be a bit of a jump up in this, given the moves in commodity prices after the US-Iran war continues to rumble on, or is that something we're not going to see coming through just yet?
Yeah, so we do expect a strong core CPI print. We think that ticks up to 0.287% month on month. It's actually not commodity prices driving it. More than anything, we're getting some payback in rent-related components after some weakness last year around the government shutdown. So, because the BLS measures rents as a 6-month change, that's actually going to, we think, mean revert higher in this April print. Looking beyond that one-off factor, we do see some rebound in core goods, likely driven by higher vehicle prices, both used and new prices, as well as some stabilization in prescription drug prices. But more broadly, it does look like, for the moment, affordability issues and crowding out from gasoline prices are having a bit of a disinflationary impulse on broader discretionary items. So overall, that's keeping inflation in a pretty consistent range. We think core PCE is going to be 0.284% month on month, following a 29 basis point reading in March. That's far too high for the Fed's 2% inflation target, and you're really not seeing too many signs of progress. And then, I would say even though this report is likely to be boosted by technical factors, there continue to be kind of more upside risks than downside risks off in the middle distance of the horizon. You do still have the price pressures from chip shortages, and while we haven't seen those commodity price pressures yet, we do think that the risks are skewed towards potentially getting some spillovers in the next couple of prints.
Okay, brilliant. I mean, the backdrop that seems to be the case for the last few times I've spoken to you on this podcast is still there. Really, a resilient labour market, risks around sticky inflation, and yet we've still got the Fed obviously potentially cutting later in the year with a change of leadership, which I believe should take place over the next week. So that will be something to watch. I guess away from the data, the other thing that's come back into the news is tariffs. There seems to have been another ruling about another round of tariffs after the initial IPA tariffs were ruled illegal previously. Can you give us an update on that, and then maybe what you think the implications might be if all these tariffs continue to be ruled against by the courts?
Yeah, so we did just have the U.S. Court of International Trade ruling that the Section 122 tariffs, which Trump implemented following the Supreme Court ruling, were sort of also not permitted under the law. So again, it's not clear if this is a final decision, and the court ruled narrowly just in favor of the plaintiffs and the state that brought the case. So it's a little bit cuspy at the moment whether this turns into a precedent and you see a broader push towards kind of undercutting the 122 tariffs, or whether this potentially goes to higher courts who overrule the Court of International Trade. So I think some very near-term policy uncertainty there. Zooming out a little bit, the 122 tariffs were sort of supposed to be a stopgap. So after IEEPA tariffs were overturned, this was what was put in place temporarily while the USTR did their various investigations into Section 301 tariffs. We still think that background process is underway. There really haven't been any legal challenges successfully to the 301 tariffs, so we think that those are likely to remain in place once they're implemented. So, I think the real upshot here is there is some near-term uncertainty for businesses dealing with the potential for tariff refunds. But looking out a little bit further, the administration is still more likely than not to get the tariff regime they want to once all the dust settles here. This also has some impact on the deficit. You're already dealing with 150, 160 billion or so of IEEPA tariff refunds, which are just beginning to go out now. We've gotten the earliest reports of that. If you do end up needing to refund Section 122 tariffs as well, that's potentially additional tens of billions in near-term deficit impacts.
Okay, cool. Thanks very much, Jeremy. That's great. And I guess that does also have some relevance potentially for how the US approaches the discussions with China coming up next week, which we're going to talk with Harrington from our team in Hong Kong shortly about. So all fitting together nicely. Thanks again, Jeremy, and we look forward to having you back on soon.
Yeah, thank you.
Well, we're going to move on to China now, and very much like President Trump moving on to China next week, where he'll be visiting President Xi, we're going to be moving on to be a very important China representative in Harrington Zhang from our economics team based in Hong Kong. Harrington, thanks very much for being on the call with us. Look, I think markets are all focused on this Trump and Xi meeting. What are your sort of main expectations around it? Do you think there's going to be any impact on what happens in Iran? What else are we going to be focusing when it comes to this meeting?
Yeah, thank you, Dom. Thank you for having me today. So President Trump is expected to pay a state visit to Beijing next week. That's Thursday and Friday next week, local time. Market expectations have been pretty reasonable on this, by which I mean there isn't that much expectation at the moment. And I think that's probably a very good thing to start with. And in terms of what may come out of the Leaders' Summit, I think there are a few things we can focus on. So first, I think we should expect some agreement on extending the trade ceasefire reached by the two leaders in October last year at the summit held in Busan, South Korea. So the deal signed back then included suspensions of some punitive tariffs, And the US export restrictions on Chinese entities, the so-called 50% penetration rule introduced by the Commerce Department at the end of September last year, Beijing's export controls on rare earth minerals, and the US docking surcharges on Chinese ships. So a baseline case should involve an extension of those suspensions for another year or two, or perhaps through the end of the Trump's second term. The second thing, there's the so-called board of investment. So following what was agreed between Chinese Vice Premier He Lifeng and the U.S. Treasury Secretary Scott Bessent during their meeting in Paris back in March. So there is a possibility that the U.S. and China could reach some sort of agreement to formally establish this new board of investment. There is also a board of trade which focuses on goods trade, but I think that's perhaps less of interest to the market. So in a more optimistic scenario, we might even see some minor relaxations around Chinese investment in the US in non-sensitive areas, by which I mean sectors that clearly have much less to do with national security concerns. And the last, the two sides will likely talk about the geopolitical issues. Taiwan will surely be on the agenda. There's no secret about that. But more imminently is perhaps the Iran issue and the Strait of Hormuz that will dominate. So on Iran, as we know that Iranian Foreign Minister Abbas Araghchi visited Beijing this week and met China's Foreign Minister and the Politburo member Wang Yi. This was Araghchi's first trip to China since the start of the US-Israel war against Iran. So there are a couple of interesting takeaways from the official Xinhua readout. So first, on the international community's common concern over restoring normal and safe passage through the Strait of Hormuz, Wang Yi urged relevant parties to respond to global calls as soon as possible. And in line with previous statement, Beijing basically reiterated its stand, calling for the reopening of the strait, while not directly putting pressure on Iran, but rather calling for relevant parties to respond. And second, Wang Yi also said that China encourages Iran and more Gulf nations to engage in dialogue and foster good neighborly relations and support regional countries in building a peace and security architecture based on broad participation, safeguarding shared interests, and achieving common development. So what that signals is that, in my view, China still only want to play a pretty peripheral, let's call it peripheral role in the resolution of the conflict. And it does not want to be deeply involved in mediation. So that's perhaps why Beijing calls for Gulf nations to sort things out themselves, basically respecting their own self-determination. If there is anything that Beijing may want to do, they may prefer to do this through the Pakistani side. Yeah, that's. I think that's what we could expect from the meeting next week.
It's a lot to kind of get our head around, especially for those maybe not quite as focused on it as you. So it's great to get your insight. You kind of touched a little bit on trade in there. What is the latest in terms of tariffs? Where do we stand, and what sort of progress do we think we might get in terms of US and China trade relations?
Yeah, sure. So let me explain this a little bit more. Given the how complicated China-US tariffs has become. So back in October last year, the US had imposed 30% of additional tariffs on China since Trump returned to the White House. That include two 10% fentanyl-related tariffs under IEEPA, plus a 10% so-called reciprocal tariffs announced on Liberation Day. The Chinese then imposed two batches of sector-specific tariffs on certain US products in response to the two fentanyl tariffs, one focused on US energy products, the other on US agricultural products. Beijing also had a 10% retaliatory tariffs against that 10% US reciprocal tariffs. So at the Busan meeting in October, the two sides agreed that the US would remove the second of the two fentanyl tariffs, and in return, Beijing would drop its retaliatory measures against the US farm products. and commit to buying 12 million tons of soybeans for that agricultural season through January this year, and that's what they did, and at least 25 million tons per year for the following 3 years. That's claimed by the U.S., not publicly acknowledged by the Chinese side. So what was left unsolved at the time was the remaining 20% in U.S. tariffs plus 10% in Chinese tariffs and some punitive measures against U.S. energy products, among other sanctions. But since the U.S. Supreme Court ruling in February, the entire 20% U.S. tariffs has been basically replaced by a 10% Section 122 tariffs. So a net reduction of 10 percentage point basically from the U.S. side. But Beijing has yet to do anything with its tariffs and retaliatory measures. So there is clearly some, let's call it, asymmetric issues here. The Ministry of Commerce in Beijing previously said they would address this accordingly, but so far we haven't seen anything from Beijing on this. So I think the two sides will try to work out how make things more symmetrical next week in Beijing. So I'm actually pretty optimistic on this. So I think on the trade broad picture, I think the two sides have reached a consensus. They should have a more prolonged ceasefire on this.
Okay, that makes a lot of sense. In terms of, I guess, there could be some positive noise there, I guess. What else would you be thinking that could come out of this that could really move the market? Is there anything else to really focus on?
Yeah, sure. That's a very good question. So that's all market care about. So first thing I would say is we need to look at the readout from both sides. So they need to confirm the meeting went well with a reciprocal visit from President Xi to Washington, D.C. Later this year. So that basically signals the relationship is on a stable footing. And the second thing is a potential upside surprise could be if the two sides can have reach any agreement on a new, as call it, a framework for bilateral relationship. That essentially eliminates the risk of major disruptions over the next few years. So basically, what markets are concerned is this relationship has become so unpredictable since President Trump returned to White House in January last year. And so if the two sides can establish a mechanism, a framework, some sort of guardrails to make sure there is a great certainty regarding this relationship, I think the market should be very happy and very happy with that. And the last thing that I can possibly think about is if they can establish this so-called new board of investment that genuinely welcomes Chinese investment in the US. So, for example, if President Trump comes out of the meeting and speak openly to the press, saying something like, "We will have some Chinese investment. We welcome them, and I will work with my team, with the cabinet, to establish a mechanism for more Chinese investment into the US," then I think that will be also quite positive.
Okay, well, we'll certainly keep an eye out for all of those potential developments, Harrington. Thanks a lot for being on the call, and we'll speak to you soon.
Thank you, Tom.
Well, moving on from China, we're going to look at the other major economy in Asia, I guess, India. We've got Aradeep Nandi, our India economist, joining us. Thanks, Aradeep, for coming on. There's been some pretty, important developments in India over the last week or so. We've had some elections, and we've got inflation data coming out next week, which we want to discuss. Let's start with the politics. Firstly, can you just talk us through the results of these elections?
So we had 4 states and 1 union territory, which is a small federally administered territory that went into polls. West Bengal and Assam were in the east, Tamil Nadu, Kerala, and Puducherry in the south. Now, in the east, in West Bengal, the BJP displaced the long-standing incumbent. BJP, by the way, is Prime Minister Modi's party, and they displaced the incumbent TMC convincingly. In Assam, there was already a BJP government which has retained power. In Tamil Nadu, an upstart party called TVK has emerged as a frontrunner, but hasn't yet got the full majority. So it's sort of a hung assembly now, and there's a lot of discussions happening on how TVK will make that cross that halfway mark. In Kerala, the Congress-led coalition has come to power, displacing the incumbent, the left administration. And in Puducherry, there was a BJP-supported coalition that's retained power.
Okay, and then in terms of how that feeds into sort of, I guess, the broader political implications, is this overall going to be seen as a good result for BJP, or how are you thinking about it from the political side of things?
I mean, if I was in BJP's headquarters, this would be excellent result, right? Because the BJP benefits from two angles. One is that it sort of cements its print in the east. So with West Bengal, with Assam, with BJP governments already in Bihar, in Odisha, the sort of north-centric identity of BJP becomes a more sort of national identity of sorts. So it gets to expand in the east. And second, I mean, it's very important to understand that the incumbent parties in both West Bengal and Tamil Nadu were very important parts of the loose anti-BJP coalition at a national level. And these are parties that are regional heavyweights, but they don't have too much of a political footprint elsewhere. So the fact that they have lost means that even at a national level, the BJP now enjoys sort of a weakened opposition. So from BJP's perspective, this should be good news.
Okay, brilliant. And then economically, does that sort of change much of the landscape when you're thinking about forecasts going forward?
Well, I mean, competitive populism is a recurring theme now of state level politics. There's freebies given for women, for unemployed youth, I mean, it's hard to believe, but in the South they've even promised gold ornaments for brides and mothers. So and these are states which have concerns on the fiscal side, right? They have elevated debt levels. They have a predominance of revenue spending. So one is, I think there's going to be a fiscal implication of all of this. The second aspect, which is a more positive side, is that West Bengal has had decades of deindustrialization. So the expectation is that with the BJP government, maybe there is improved governance, maybe better ease of doing business, more infra spending, better coordination between center and state, which is again a positive medium-term tailwind. For markets, it does reduce the political risk premium. The one thing that markets are watching out for is potential petrol diesel hike. Given that the state elections are over, these are prices that haven't changed for a very long time, and after the Iran war there's a lot of focus on this, and finally, I mean, if that takes place, then there could be some impact in terms of inflation and growth. But yeah, overall market seems to be interpreting this positively.
It's interesting you mentioned there, the CPI and almost the price controls on some of the commodities and things. We do have, as I'd mentioned right at the start of the section, we've got inflation data due next week for April. I guess it's sort of really the first month where we might start to see some signs of the inflation coming through from the Middle East conflict. How are you thinking about the inflation number for next week and more broadly outside of that? Is inflation set to pick up more aggressively in India, or is it something that's going to be somewhat managed over the next few months?
So, Dominic, it's interesting you mentioned that this is probably the first month where inflation impact could come up. Well, actually, it should have even come up last month, but it didn't. So last month it was 3.4%. We expect inflation to pick up to 3.7% in the April print. A very important reason why inflation isn't picking up as much is because, well, effectively India is doing a fiscal defense, so to speak, of growth and inflation. And the way it's doing that is by administering fuel prices. So household LPG prices, petrol, diesel, kerosene, they've hardly gone up, right? So by keeping them constant, the inflation impact of the conflict is dampened to some extent. The fact that the fact that there is, of course, higher input costs. It's not just fuel that companies are facing, and yes, companies are facing margin pressures. So one of the things that we are looking for in this print is to see if there is there's an increase in inflation, in the momentum in the broader core basket. But overall, because petrol diesel prices aren't picking up, and it's part of the core basket, interestingly, in India, we expect core inflation to inch up to 3.5% from 3.4% in March. Overall, for FY27, we are expecting inflation to remain relatively capped at around 5%.
Okay, brilliant. That's really helpful. I appreciate all of your insights, especially on the local elections, which I know are a big interest to a lot of investors. So great to hear your thoughts on that and CPI. And we look forward to having you back on the podcast very soon.
Thanks a lot.
Well, we're going to finish this week in the UK with George Buckley, our chief economist for the Euro area and the UK. And we're going to start by talking politics, which we've discussed already, sort of geopolitics in China, local politics in India, and now local politics, I guess, in the UK. George, as we're recording this, it is currently polling day in the UK, so we don't know what the results will be, but it's likely to be a sort of bad night for Labour, as it were. What do you think this means for Keir Starmer going forward, and what will you be watching in the sort of weeks ahead politically?
Well, I think, Dom, the as you say, we're recording this just at the time that voting is happening, so we don't, and we won't even know on Friday whether we where the situation will be. It's going to take until really after or over the weekend until we have a clear picture. But the simple answer to your question is that the more seats that Labour loses, the greater the challenge it's going to pose for the Prime Minister, who's already in quite a bit of trouble and could really do with losing as few seats as possible. I don't think there's any question that they're going to lose a lot of seats in this to the Green Party and particularly to Reform. Reform hasn't been doing quite as well over the last few weeks or last few months than it had been doing, but it is still doing exceptionally well in the polls. And the fact is that you're comparing to a period where Reform and the Greens had very few councillors indeed. So they are going to increase their tally substantially, and that will come at the expense of the traditional parties and especially Labour.
Okay, well, a lot of potential, volatility, I guess, in politics over the weeks or months ahead, which the markets will certainly be watching closely. But the other element of volatility, I guess, in the last few weeks has been around interest rate expectations on the back of changes in oil prices. You guys recently changed your forecast for both the ECB and the BoE. I was just wondering if you could give us a bit more colour on what you've changed and why.
Sure, we've added rate hikes to both of those views. More for the ECB. So we've added 2 hikes in June and July for the ECB. We've added 1 hike for the Bank of England. And just to support that idea that the bank is going to be more dovish or less hawkish than the ECB, we think that they will ultimately take that one out and more. So we think they'll cut rates towards the end of 2027. The reason we've done that is because of, not surprisingly, higher energy prices. There's a very tight relationship, or there has been a tight relationship between oil prices and how much is being priced for fixed income markets, so how much is expected from higher rates by the end of this year. Very tight relationship since this war began. Of course, it's not long after we changed that view that there has been now some discussion about whether a peace plan might come to fruition. If it does, then of course that might lead to our view not being right. But there's a lot of questions now about, first of all, what will second round effects look like? And that's something that central banks will not know about for some time. And secondly, how long and how high will energy prices go? And I think there's a real possibility now that over the next few days, we'll be watching very closely as to whether this peace agreement has any legs. And if it does, then there is a risk we might have to do exactly the opposite and take those rate hikes out. But for the moment, we're looking for small rate hikes over the next couple of months.
Okay, brilliant. I guess just looking to the week ahead, it's not a particularly busy week in the data calendar in either Europe or the UK, but we do get a few bits and pieces, some survey data in Europe, UK monthly GDP. What are you looking for in those data sets? Do you expect to see many signs of slowdown from the war or a bounce back after some of the more positive recent news? How are you thinking about that?
Yeah, as you say, Dom, there's not a huge amount of data, but one thing that I would highlight is that these surveys are probably the most interesting because they're covering May, for example, for the ZEW survey. That's a survey of expectations and current conditions from economists. You've got, as you mentioned, GDP data, but that's for March. So it really does start to encapsulate the start of the war. But equally, it's probably going to be quite strong because February was quite strong. So I'm not sure how much weight to put on that. I don't think it's going to give us that UK GDP print a true understanding of what's happening at an underlying level on growth. But as you say, there's a few bits of data worth watching. Probably the surveys are the most important.
Great. Thanks, George. I appreciate you being on the show, and we look forward to speaking to you soon.
Thanks, Dom.
Well, that's a wrap for this week. Thank you as ever for joining us for this whistle-stop tour of all things macro and markets in this podcast, which was once again edited and produced by the brilliant John Dalton. If you enjoyed the podcast or would like to hear more, please like and subscribe to The Week Ahead and more of Nomura's podcasts on Apple, Spotify, SoundCloud, or wherever it is you get your pods. We'd also love to hear from you, so please leave a review and let us know what you would like to hear more of. Please also feel free to share this podcast with friends, colleagues, family, or anyone you think would find it interesting. For more, you can log into nomuraconnects.com to keep up to date and to keep on listening. Thanks once again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.